Welcome back. Take a look at futures, where we are expecting another big rally at the start of trading this morning. The Dow Industrials right now up 154. The Nasdaq is up 101. The S&P higher by 21 as this year-end rally gets stronger every day. The final read of third quarter GDP is out this morning. In about 2 hours' time, economists are expecting that the economy grew by 5.2% in the third quarter. This will be the final read. We are also getting the November PCE out. That's tomorrow. We want to talk about what to expect here with right now Portfolio Wealth Advisors Chief Investment Officer Lee Munson. Lee, great to see you. Merry Christmas to you. Happy holidays. What are you expecting in terms of the data in the face of this huge market rally? We've got a market climbing a wall of worry going into year end. What do you think is the reason for this big rally?
I think a lot of people, first of all, it started off with a little bit of volatility in October where everybody's, getting overweight on that correction. I think people are trying to chase these Fed cuts. I think that the investing public is under some, it's almost like a spell that the Fed's going to start cutting rates real fast. The problem with how fast we've come, I'm unsure why the Fed would start to cut rates until we see the PCE have a 2.99, anything without a 3 in front of it, for a minimum of 3 to 6 months. Do we really think the Fed's going to cut that quickly? We also have employment compensation, the ECI, that type of inflation, that hasn't come down that much. So I love this rally, but this is not a Santa Claus rally. We've had the biggest inflow last week to the SPY ETF, we call it the spiders, since forever. We have a short-term rally that we haven't seen this strong in 30 years. I think it's a huge catch-up trade. I love it. I'm not really selling into it, but I think people have to realize if we make 10% earnings growth next year and we keep the multiple where we're at now, that really only gives us maybe about 8-9% upside for all year next year. And that's if nothing goes wrong.
Right. And we're seeing an economy that is slowing. Amazing that we're expecting 5.2% from the GDP this morning. But then in the fourth quarter, the Atlanta Fed is all the way down to about 1.5%. Are you expecting a slowdown in 2024 for the economy?
Well, I don't know how we shouldn't expect it. Now, I know everybody wants to say something provocative and say there's going to be something out, a left field. But the reality is that everything that we look at, you might say, hey, maybe the analysts have brought their estimates down enough. But everything we're looking at in a slowdown with rates this high, with the Fed saying we may only cut 75 basis points, I don't see how we're not going to have a slow growth, a mild recession. I'm not saying it's a hard landing. But you got to look at a basic mild recession. How are we going to hit that numbers? How are we going to get the S&P to go to 51, 5,200 without just expanding the valuation and just increasing the multiple? That seems rather unlikely.
Yeah. Mark Tepper.
Lee, when you look at the broader economic landscape, we've got economic growth, which is slowing. We've got inflation, which thankfully is slowing. We've got monetary policy, which is still currently restrictive, but likely set to ease in 2024. Given those things, where should investors be looking as far as maybe companies go, sectors, asset classes? Where's the best place for investors to be looking as they try to position their portfolios for 2024?
I can tell you that I've never been more balanced between those very large mega caps, which, by the way, have some interesting growth rates going into next year in the double digits. Outside of Apple, you have some real stuff there. And then look at what happened in the last month. Look at the rally in small caps. Now, you can say look at the rally in things that are unprofitable and really kind of crappy companies. But when you just look at small cap value, 10, 12%, look at a 2-year chart, whether it's the S&P, the NASDAQ, or small value, everything's up. So I would say right now, the easy trade, if we get in and then get out of a mild recession, you want to have smaller companies that are cheaper, your banks and defensive names, cyclicals. That's where you want to be as we get out of this. But I also have to say, when you look at where the S&P is getting its growth rate, there is a case to be made for even a value guy like me to have some exposure to the NASDAQ 100. And that's just a sad world we live in. I don't like to say that, I want to have some more exposure to that, but I got to go where you can grow.
Yeah, it's a great point, Lee. And it's great to see that you're going wherever the growth is. Lee, we'll be watching. Thanks very much for being here.
Thank you.
All right, Lee Munson joining us. Quick break, and then